Hey everybody, my name is Colin and welcome to the new show. I'm doing this series of videos for people that love real estate and love real estate investing. And whether you're a rookie just starting out or a veteran with many deals under your belt, my aim is that you'll find something here that will help you accelerate your real estate journey in any economic cycle. To tell you a little bit about my own journey, I'm originally from Ireland and now live in Tampa, Florida. I've dabbled in a lot of different real estate investment types over the years, including buy and hold, fix and flip, wholesaling, loan notes, private lending, tax liens, foreclosure auctions, student apartments in the United Kingdom, vacation homes in Spain, a little bit of everything really. But for the last 5 years, I've been what you might call a traditional fix and flipper in the Tampa market. And with my colleagues, I've bought, sold, and renovated more than 350 single family homes. I also enjoy podcasting and doing these videos and, generally helping people achieve financial freedom before they're too old to enjoy it. And when I record this in June 2020, for me, it's still a very foggy market. The fog from this virus is definitely not cleared for real estate. The stock market seemed to be shrugging off the impact, although what happens later in the summer and the autumn remains to be seen. But there's a long way to go before real estate goes back to what might be considered a normal market or a normal curve. And during that gap, I think it's important that you invest very safely and with a few extra things in mind. So I'm going to tell you my top 10 tips for investing in the post-COVID economy, which is really a mixture of some major trends I'm seeing in the market and also some common sense tips that you could generally apply to any market cycle. So without further ado, here are my 10 steps to investing in the COVID-19 economy. So step number one is make sure your own house is in order and increase your reserves and liquidity. And what I mean by getting your house in order is not to declutter the garage and tidy up the guest bedroom, although that's pretty therapeutic, I'm sure. It's more about your household finances. And if you're not currently tracking your household income and expenditure in a special spreadsheet, you absolutely should get started now. And I'm going to provide some free tools to help you do that in the near future. And the reason is very easy. If you don't know exactly where your money's coming from and exactly where your money's going out, it's going to be impossible for you to maximize your investing potential. You need to track that amount very carefully, month by month, and it needs to be itemized. Okay? It's not that difficult to do. Once you have a system up and running, it shouldn't take you more than about 30 to 40 minutes per month to track it. That's what it takes me to track my household expenses. And once you have that done, it should be very easy for you to find out what your average monthly expenses are. And once you've done that, make sure you have at least 6 months worth set aside in a do not touch account. So if you're spending $6,000 per month on average for your mortgage, your groceries, your Netflix, your school fees, etc., make sure you've got $36,000 in a do not touch account. That doesn't get spent on anything else. That is your reserves, your rainy day money, and it's very important that you keep it there. And so once you have your household expenses in order and your do not touch money, then it's time to make sure the same applies to any investments you might have. So if you own some rental properties, again, work out what they're costing you every month, what the income is, what the expenses are. Again, track it in a spreadsheet every month. Don't just receive the property manager's spreadsheets or PDFs and kind of put them in a folder or leave them in your inbox. Actually create your own spreadsheets tracking each individual rental and what you're receiving net every month, and make sure you have 6 months of reserves for each individual rental property, and again set them aside in that same do not touch account. And it's very important that you do that to enable yourself to invest freely and smartly. Obviously, if you're an investor or a flipper or a wholesaler, it takes on a whole different meaning now. Whereas before, during that very long boom we had from 2011 up to early 2020, you could generally afford to be quite aggressive in terms of borrowing as much as you can, stretching your resale prices, paying top dollar from wholesalers or paying top dollar from sellers or foreclosure agents, and generally having that aggressive approach paid off, and you made more money doing it than you would have done if you stayed conservative. Things might have changed a little bit now, and you probably want to be a little bit more conservative with your loan to value ratios, your resale prices, your profit margins. Just tighten it up a little bit in the new post COVID-19 economy compared to what you've done in the past. Okay, so that's step one. Step two is pretty straightforward, and that's simply to brush up on your digital skills. There's a lot of tools out there now that make selling a house much easier than it used to be, and taking professional photographs is one of the best decisions you can make. I had flipped probably 150 plus houses before I actually took the plunge and realized that I needed to hire a professional photographer. Before that, either myself or my colleague would have gone to the house, spent about an hour taking photographs, gone home, spent about an hour uploading and editing them, and they still look crap compared to what a professional could do for about 120 bucks. And so I was spending 2 hours per property doing that, and we were doing up to 10 properties a month. So you can imagine how much time we were spending on these photos, and paying a professional to do it for a very nominal amount of money was just a total no-brainer. We later added drone photos for a little bit of a wow factor. And then back in early April, we decided to do Matterport virtual tours as well. So people could do a virtual tour around their house and kind of click, click, click to walk into each room, look up, look down, look into every corner. That really made it a lot easier for our out-of-state buyers to buy the rental properties that we were renovating. So the cost of all of that is less than $250, which is, quite minor compared to renovation budgets or sales prices or even a realtor's commission. So you don't need to be tech savvy to get into all of this, but I highly, highly recommend, whether you're doing one house a year or 50 houses a year, get a professional photographer to take pictures of those houses, add on drones and Matterport virtual tours if you can, if it's available. It's not a lot extra. And even as a buy and hold investor, it's very, very useful to have top quality photos of your house when it was in its nicest condition. They're very useful for when you need to re-let them. When the tenants leave and new tenants are moving in, you can use those photos. So if you're not doing that now, get a professional photographer and add the bells and whistles. It's well worth it, no matter how small or big an investor you are. Step number 3 is, if you have tenants who aren't paying, get out in front of it. Now, we're all very worried in March, April and May that there might be huge waves of defaults of tenants not paying their rents. And thankfully it didn't happen at all. In my rentals, which I own in Florida, Ohio and Alabama, they all basically paid on time. It was like a normal March, April and May. We're all worried that it was going to be catastrophic, but thanks in no small part to a massive government intervention, tenants were able to continue paying their rent. It was also thanks to much higher communication from the property managers. They probably 5x their communication with tenants, just letting them know the sources of help that were out there, the consequences of not paying rent, and most of all the consequences of not communicating with your manager if they had any problems at all, and negotiating solutions and payment plans for those that were in genuine distress. So communication is absolutely key. Communicating with your property manager if you have a manager, and communicating with tenants if you have them. By all means, try to avoid losing a tenant that's had a solid track record and a solid history of paying. If they have a temporary problem due to illness or due to job losses, try and work with them and try and point them in the direction of assistance and help that is out there. But communication is absolutely key. You need to know exactly what your tenants are doing, and they need to know the consequences of not communicating with you and not paying their rent. And even though foreclosures and evictions are in moratorium throughout most of the country, and it's you can't evict people during this March, April, May, June period, you can still get the paperwork started in most states and advance that along, so that if they do continue to act inappropriately and continue to stop paying their bills, that you can take action against them as soon as the doors open again. But again, I've always found that clear communication, professional management has been ultra effective in managing tenants that are in difficult situations, and in training tenants that might not be as financially organized as they should be. And so far it hasn't been that bad. But always get in front of it. Communication is always key. You need very open communication lines with your managers and your tenants at all times. So step number 4 is to avoid buying occupied homes. Now, anybody that's been in real estate a while will know that buying and selling and dealing with occupied homes has always been a lot more difficult than dealing with vacant homes. And the COVID-19 pandemic has just exaggerated that trend tenfold. I personally sold more than 20 properties in March, April, and early May of 2020, but they were all vacant. And that was the main reason they were so straightforward to sell. You've probably heard stories about occupied properties. A lot of sellers just simply took them off the market because they didn't want people coming into their house during the height of the pandemic. Property inspectors, appraisers, photographers, realtors, notaries, all these people were very reluctant to walk inside an occupied house, and it's very difficult to get a transaction processed when you have that type of feeling out there. There's some new technologies coming with remote online notarization and things like that, but it's very difficult to sell a house if certain people can't get in and out, sometimes several times. Whereas occupied houses, on the other hand, everybody was very happy to go in them. You might leave some hand sanitizer on the front door, but photographers, appraisers, inspectors, prospective buyers, prospective tenants, property managers, realtors, everybody was able to go in and out of a cleanly renovated, professionally cleaned, vacant house. It was a totally different product type, and it's just going to remain that way for the foreseeable future. Occupied homes are a lot more difficult to deal with, and especially if you're a rookie starting out, I would not encourage you to deal with occupied homes. If you're looking to wholesale or be a buy to let or be a property flipper, your life would be a lot simpler just dealing with a vacant property. A lot of this is got to do with light lifting versus heavy lifting, and occupied homes are generally would be considered heavier lifting, and that is all the more the case in this new COVID-19 economy that we're in. So if you can, avoid dealing with occupied homes. Concentrate your efforts, your sourcing efforts, your purchasing efforts, your renovation efforts, whatever they may be, on vacant homes, and you'll find it a lot easier to do business and generally make money. So step number 5 is to avoid speculative investing and avoid heavy lifting. And I've bought and sold hundreds of properties in the last 5-6 years in particular, and some of those were light lifting and a lot of them were heavy lifting. And during a boom, when prices are pretty much going up continuously and there's more buyers and sellers, it makes more sense to scale up and do as much activity as you can rather than limit yourself to just the easiest deals. Now, I have a feeling that we're at the top of a cycle now, and that the types of real estate you want to acquire and the types of activity you want to concentrate on, we're better off doing light lifting than heavy lifting. And by that I mean avoiding weird and difficult properties. So avoid properties that are much bigger than average, much smaller than average, much older than average, or are in busy junctions or have really nasty neighbors. Those properties are always more difficult to sell, but you can get away with it during a boom. And during a downturn, or even when the market is peaked and is dipping slowly, they're the types of properties that can just sit on the market and make it much more difficult to get a profit margin out of. So even though you might think you're getting a good deal for buying that house that's just an outlier, if the average property is a 2,000 square foot concrete block home, don't buy a 3,500 square foot home. If the average age is 40 years old, don't buy a house that's 70 years old. Don't buy a house that's got a super weird layout, that's only got one bathroom on the top corner of the house. Avoid houses in really, really busy junctions because they're going to be more difficult to sell. And also, if you have neighbors, that are like the Dukes of Hazzard, just accumulating junk, or with a bunch of junk dogs, again, try not to get yourself involved in those houses. They're going to be much, much more difficult when the market starts turning, as they are when the market is just on a normal upward curve. So, during a boom, you can pretty much do anything and everything if you have the experience to do it. But during the top of the market, or during a time when the market is dipping and potentially falling in the near future, stick to the easier houses that's average size, average layout, average age, regular streets. They're the ones that are going to make your life easier. They're the ones that are going to help you avoid very expensive mistakes. Step number 6 is that even though prices might dip in the near future, don't expect the major falls that we saw in the 2008 and 2009 crisis. I was contacted by an investor a few weeks ago here in Tampa, Florida, that was requesting properties in my market for 25 cents on the dollar. I was pretty polite to him, but I clearly thought he was deluded if he thought he was going to get those types of deals in this type of market. If and when prices fall, guys, it might not happen until early 2021 or even early 2022. There's a lot of reasons for that, but the 2020 crisis, real estate crisis, if there even is one, is not going to be anywhere near as severe as the 2008-2009 crisis. And there's a few reasons for that. The first reason is that buyers have a lot more equity in their homes. You know, the underwriting for the people that were getting the mortgages during the last 6-7 years is much, much stricter than it was 12 years ago. These buyers are a lot more qualified. The deposits they're putting down are in many cases much higher, and their reserves are much higher as well. You simply weren't getting the no-doc loans and the crazy loans that were being, subprime loans that were being given out to so many hundreds of thousands and possibly millions of people 10, 12, 15 years ago. You're just not seeing that anymore. The second reason is that a lot of people have been taking advantage of low interest rates to refinance their houses in the last quarter. That activity has spiked tremendously. So a lot of people that might be in some sort of distress and might need to sell their house, they're not as distressed as you think, because they're probably sitting on a lot more cash than people were 12, 13, 14, 15 years ago. Okay, the third reason is that we have a lot of forbearance now. And even though the levels of forbearance are lowering, which is good news, a lot of people did take advantage of it, which means that you just can't, people aren't going to get foreclosed on, people aren't going to be under the same pressure to do a short sale as they used to be. Banks aren't going to be grabbing real estate the way they were before either, because banks don't have the same liquidity crises either. Banks are flush with cash, corporations are flush with cash. A lot of regular people are flush with cash because they're refinancing their homes or they're postponing their mortgage payments. So all of these things, this wall, this huge tsunami of money that's been protecting us for the last few months, is also propping real estate prices up and could continue to do so for quite a while. So if you're a wholesaler or a flipper and you think that firing in lowball offers is going to get you a good deal, you're probably going to be wasting your time just as much as you would have been wasting your time if you're doing it at the beginning of the year or the end of last year. Sellers just aren't that distressed. You can probably offer a little bit less because transactions are down and there's less activity in the market, but not a lot less. And you can maybe negotiate your inspection terms or other terms a little bit. But again, I don't think you're going to see much difference for a while. And look, if you're a buy and hold person, again, I wouldn't overthink it. I wouldn't think I need to wait a year or I need to wait 2 years or 3 years to get a good deal. A buy and hold person shouldn't be worried about the 1 to 3 year impacts on what's a 20 or even a 30-year investment for them. Just stick to your criteria, stick to the safe house types, make fair offers, put good tenants in there, get your reserves in order, and you'll be fine. If you buy a house for $200,000 and it dips to 190 and 180 and then goes back up to 200 and so on over 5, 10, 15 years, you don't really care about that. That's not why you're investing. And I'll podcast more about that in other shows. But buy and hold investors should never worry about timing the market or getting their time exactly right. Those short-term gyrations don't matter much. And for people they do matter for wholesalers, for flippers, for sellers, I don't think we're in a market where you need to discount heavily. I don't think we're in a market where you can lowball people substantially. If it's going to dip, I don't think it's going to dip a lot, and it might not do so until 2021 or even further beyond. There's just too much money out there propping up the prices. Okay, so that's step number 6. Step number 7 is, if you're a seller, price it fairly, be patient, and just get it sold. I think we're in a holding pattern at the moment as far as real estate prices are concerned, certainly in the Tampa, Florida market and probably in most major metropolitan areas. We're not seeing the appreciation, the very steady long-term appreciation that we've seen during the last 8-9 years. It's kind of flattened out a little bit, but we're not seeing the falls either. So it's kind of in a holding pattern. So if you're a seller, this isn't the time to try and drive a hard bargain. If somebody makes you a fair offer, I think you should just go ahead and accept it. People might get a little bit more demanding with their inspection requests and some other requests, and you can push back a little bit, but don't push back too much. Also, if you've ran over budget on a renovation, be very careful about trying to make up for that on the sales price. During a boom, you can maybe run over budget by $2 or $3 or $4,000 or even more, and tack that onto your sales price, and just keep your fingers crossed that an appraiser is going to appraise it and you're going to get away with it, that you thought you were going to sell it for 150, but then you decide that you need to sell it for 155 or 160, and a lot of times you're going to get away with that. But I think those days are probably behind us. I think you need to price it at your original after repair value. It needs to be a very solid, fair price. If you're trying to comp it with a house across the street that has a new roof and a new kitchen and your house doesn't, again, I would avoid doing that. I would just be very honest with yourself, be brutally fair, and try and price it as to what you would want to pay for it as a buyer. That's the kind of price you're going to get it sold at. It's not the time in the market to drive a hard bargain, to try and stretch yourself, to try and squeeze that extra $5,000 of profit. Just get in, get out, get it done, keep your margin and move on, and don't be too greedy. Same thing if you're a homeowner and you're selling a house that you've lived in for many, many years. Don't get too precious about your kitchen and floors and windows and bedrooms being much, much nicer than the other comps. Chances are, to a neutral person, they're probably not that much nicer. So try and be neutral about it and value your house neutrally. Don't be adding on that extra, 5 or 10% of nostalgia value onto your house. Just price it fairly, because you don't want it sitting on the market for months and months and months when you have potentials for second waves or potentials for stock market crashes or all sorts of things. If you have a good offer on your house, just get it sold. Step number 8 is to target low density and affordable single family homes that are well below the median sales price. For the last 5 years, that's pretty much all I've done in the Tampa Bay market, is targeting homes in the $140,000 to $160,000 range when median house prices were over $200,000. They were lower middle class suburban neighborhoods. And while it's certainly not the sexy end of the market, it is quite steady, it is quite reliable, and it was quite profitable as well. And I think that's going to be even more true in 2021, 2022 and beyond. These are by far the lowest risk real estate asset classes in my view, these suburban single family homes priced below the median. Okay, that's very, very important that you consider that strongly if you're going to be buying real estate. And just consider the alternatives that are out there. One of them is high quality apartment complexes. People have been overpaying for those for years. I mean, you've had a lot of savvy investors like Ken McElroy exiting out of them over the last 3-4 years, and other people have been buying them with very low cap rates, 3-4% cap rates, very high leverage, rosy occupancy assumptions, rosy rental increase assumptions in the near future, and they're just going to get burned. They were going to get burned anyway, and they're going to get doubly burned now that living in a highly priced apartment complex is much less appealing than it would have been 6 or 8 months ago. People just don't really want to be living on top of each other and having all those shared amenities that they might even be scared to use. Another alternative is low quality multifamily. That could be low quality apartment complexes or low quality duplexes, triplexes and quadplexes. I've never been a fan of that asset class. It is just too difficult to manage. It's too difficult to deal with. I'm talking about low income areas that have high unemployment, high vacancy, sometimes high crime, and they're just not suited, certainly to passive investors. They're not suited to out-of-state investors. They're really only suitable for local landlords that really don't mind rolling up their sleeves. And a lot of the time, these people are slum landlords that just run them into the ground and just try and sell them onto a sucker before they have to replace the roofs and ACs and water heaters and everything else. So while the gross rental ratios often look fantastic for these on paper, somebody might offer you a duplex for $100,000 that in theory rents for $1,200 a month. The reality is often different, and the reality is that you often get burned and they can cost you money month after month after month, and you can have to sell them at a lower price than what you paid for them. So I would avoid that. Another asset class is high quality single family homes. And unfortunately, the people that live in high quality single family homes are amongst the most price sensitive out there. and they're amongst the first to bail whenever things get difficult or whether they get a whiff of anything bad coming in the economy. So they're the most difficult houses to sell right now. If you're trying to sell $1 million house in Tampa or any other big city, it's going to take you longer than it would have done last year. If you're trying to rent $1 million house, whereas last year they might have rented for $5,000, $6,000, $7,000 a month, this year, next year, they're going to be less than that, I promise you. So those people can be quite fickle. And if you've been used to, if you're a flipper in the high-end market, you're used to buying a house for 500, spending 200 and selling it for 900, those profit margins can disappear from 1 month to the next, never mind 1 quarter to the next. So your what might have looked like $150,000 profit can completely disappear because your after repair value changes so quickly. And that just doesn't happen to anywhere near the same extent in the affordable section of the market. There's always people that can afford $150,000 house, whether to buy it or to rent it, and they're just not as price sensitive. The prices don't fall as much, the rents don't fall as much, and whether you're in a boom with people moving up the ladder or you're in a crisis with people moving down the ladder, there's always going to be the fattest, highest part of demand in that single family home sector, in affordable housing, suburban housing. You're always going to have somebody living there paying a fair rent. So think about that very carefully if you've been dealing with a lot of different asset classes, apartments, multifamily, high quality, very low quality. Try and consider staying in that safe, affordable area, not too high, not too low, kind of the Goldilocks property for me, to be honest with you. And in the Tampa Bay market, typically in the $150,000, $160,000 price range, fully renovated. That's what's done very well for me over the last 5-6 years. And I think it's going to continue to be the case, much more so than other asset classes. Step number 9 is that you should pace yourself. This is a multi-phase situation. I think there's going to be 3 phases here, and I think it's going to take 2 years for the fog to clear from the real estate market because of this pandemic. When I published this, it's June 2020, and we've just finished what I call phase 1, which was the initial and incredibly severe lockdown period. So lockdowns, certainly where I am in Florida, have eased tremendously, and businesses are trying to get back to normal as they needed to and as they should do. And now we're going to be entering into phase 2. And phase 2 could last up to 18 months. It's going to last a long time. And phase 2, you're going to see unemployment peaking and then falling back down to normal. And even the most optimistic economists out there will tell you that there's going to be far, far more people out of work in January 2022 than there were in January 2020. There were 6 million people out of work in January 2020, which was pretty much a record low. And while it's going to be much lower than it is now, it's still going to be a lot higher than 6 million in 2 years' time. It could be 12 million, it could be 15 million, 18 million, who knows? But that high unemployment is going to have an impact on the real estate market, and that really remains to be seen. We haven't seen it yet because the market is being propped up by government money, but we're going to see it, and we need to be careful during that period. Phase 3 is when a vaccine is found and widely distributed. Both have to happen. There's not point in just having it being found and distributed to a few thousand people or even a few million people. Phase 3 is when it's widely distributed. And I'm not a scientist. I'm reluctant to weigh in on when that will be. But I think if we get there, if you have a vaccine by January 2022, if I have a vaccine by January 2022, and our friends and family and major businesses and major population centers, I think that would be a historic achievement. But it's only after that happens is that the market can get back to normal, can get past this pandemic disruption. And that could be a while away. That could be easily in 2022. And I'm not saying you can't make money between June of 2020 and January of 2022. Absolutely, you can make money. You should make money. You should continue learning. You should be making deals. You should proceed forward, get on with your life. Nobody wants to hide in a corner. But it's what I call a gap. And it's not that easy to make money during a gap. It's easier to make money when the market's going up and when the market's settled again and when it's going up again. Making money in the gap is a little bit more difficult. You can still do it, but just proceed with caution. And bear in mind that this is a multi-phase situation, and don't gamble everything you have during that gap. Use it as an experience to learn and stay active and get deals done and get experience, because experience is going to be very, very valuable to you when we exit out of this fog. But pace yourself. Like I say, just pace yourself. Don't try and accomplish everything in 1 quarter or 2 quarters. Listen a lot more than you talk, and learn a lot more than you spend, and you'll be doing okay. But keep doing deals, keep active, but be careful. Mind yourself. Step number 10 is in many ways the most important step, and that is to stay positive. It's always a very useful trait to have in business. I always try and stay positive, think about positive things in life and in business. And real estate's all about cycles, and trying to time the top of the market, trying to time the bottom of the market. It's generally a waste of time. You just can't do it. You'll never know when is the perfect time to investing until after it's been and gone. So if you're an investor, you just have to learn how to get used to the ups and downs. We're probably at the top of the market right now. And if it does drop, it might be a very short drop or it might be a very steep drop, but you just don't know. And there's no point in waiting and waiting and waiting to find out either. My advice instead is to figure out how much you want to have invested between now and when the bottom of the market appears, and spend part of that money today. So if you did that and you were a wholesaler and a flipper and the market didn't fall for quite a while, you'd be very glad that you kept investing and you can bank the profits of those deals. Or if you did start investing and the market fell quite dramatically, well, at least you didn't spend all your money and you kept some of your powder dry, and now you're able to take advantage of some bargains that are starting to appear. That's just life for real estate investors who don't know where the market is going. And that's just life for any type of investor who accepts that they don't know what the future holds. So, but look, if you're a buy and hold person, like I said earlier, you shouldn't really care much about short-term ups and downs. You're buying real estate for different reasons. You pay $200,000 today. Chances are the bank have paid 150 or 60,000 of it. Chances are a tenant is going to pay back the vast majority of that money for you. You're going to get tax advantages. You're going to get an inflation hedge. You're going to get equity pay down. You're going to get some cash flow. So that the short-term ups and downs really don't matter that much to you. And real estate flippers and wholesalers and realtors who just earn income and spend the income on their lifestyle, they're really missing a trick, because for me it's all about accumulating assets, accumulating wealth, accumulating passive income streams, accumulating things for future generations to manage and to get involved in. And that's what it's all about for me. You need your why. You need to know why you're doing it. So again, if you're a buy and hold person, you shouldn't care much about the short-term ups and downs. If you're a flipper and a wholesaler, as long as you don't spend all your money now, you'll be fine. Spend part of your money between now and when the bottom is reached, and then spend more when the bottom is reached, and just keep going, keep doing business, because real estate teaches you a lot, and a crisis teaches you even more. Crises teach you how to be creative, teaches you resilience, teaches you toughness, and you learn a lot more making mistakes and doing deals than you do just kind of sitting on the sidelines biting your fingernails. I remember very clearly the 2006 to 2010 period where we saw massive appreciation and then massive drops in prices, and I learned a lot during those periods and have the scars to prove it. And I don't think the next 2 or 3 or 4 years are going to be as extreme as that. I think there's going to be some lessons to be learned, and there's going to be some changes in the market. But like I say, the main thing is to keep learning, keep doing it. Bear in mind that the market is going to be a little bit foggy, probably for 18 to 24 months. So just thread a little carefully during that fog. All right. So let me just recap really quickly those 10 steps. The first one is to increase your reserves and your liquidity. Make sure you have good control of your household finances. Make sure you have 6 months reserves for your personal home and any other rental homes you have. Step number 2 is to brush up on your digital skills. Spend that extra bit of money on the professional photos, the drones, the Matterport virtual tours, whatever you need to do. It is well worth it. Even if you're a buy and hold investor, having those for property management purposes is worth it in and of itself. Step number 3, if you have tenants who are not paying, get in front of it. Having crystal clear communication lines between you and your property manager and your tenants, and you and your tenants, if you're managing them directly, is very, very important. You need to be aware of all of their options, and they need to be aware of exactly what's going to happen for different scenarios. Communication is key. Step number 4, avoid buying and selling those occupied homes. They were always a little bit more difficult to deal with, and that is just even more so the case now. Step number 5 is to avoid speculative investments and avoid just that heavy lifting. Basically, if a house is bigger, smaller, older, weirder than everything else, just stay away from it. Stay with the easy stuff, the houses that are normal, cookie cutter houses, if you want to call them that, but stay away from the outliers. They're going to be a lot more difficult to sell during the next 18 months than they were 18 months ago. That's a fact. If you're a buyer, don't assume sellers are going to accept lowball offers. That's step number 6. I personally don't think we're going to see massive real estate drops in the next couple of years. I might be wrong, but I don't see how that's going to happen. So don't avoid doing deals just because people aren't giving you a 30 or a 40% discount. Just go with the flow and continue doing some trading. Number 7 is, if you're a seller, price fairly, be flexible, just get it sold. Don't try and drive a hard bargain. Don't try and add your renovation excesses onto your sales price. It's probably not going to work as well now as it may have done before. Step number 8 is to consider very carefully targeting affordable single family neighborhoods priced below the median price. They are, for me, much safer than higher priced apartments and multifamilies and higher priced single family homes, and they're also a lot safer and easier to deal with than the very low income stuff, which has always been problematic and will continue to be problematic. Number 9 is to pace yourself. This is a multi-phase situation. The fog is probably not going to clear in the real estate market for another couple of years. So be careful during that gap. Try to avoid taking massive gambles, but continue to be active, continue to educate yourself, continue to do deals. And step number 10 is to stay positive. Stay positive. Every crisis has a solution, an expiration date, and a life lesson. You're going to learn them, same as everybody else. And if you're active and learning them, you're going to heed those lessons a lot more closely, and you're going to use them to go on to greater and better things as life goes on and we get out the other side of this and keep doing business. So that's it for me. I hope you've enjoyed this short video. My name is Colin. If you can give me a like or a subscribe, I'll really appreciate it. Thanks again. You guys take care. Bye-bye.